What I want to do is talk to you a little bit about, the kind of the evolution of the market. We've talked about, you hear us talk about in our meetings and our trainings that over the years, the industry did improve, and it really, in fact, did. And if you remember, the old standing plan is, of course, everybody knows it as whole life, right? Okay, whole life is, as most of you know, has been around for probably the original form of policy that was ever sold the consumer. And of course, from there, it evolved, though, okay? So from whole life, we went to universal life, okay? And many of you have heard those terms. And then from universal life, we went to variable universal life, okay? And then from variable universal life, we went to indexed universal life, right? So that's been the evolution. Of course, in there, term insurance has always been a pretty common component. And what I wanted to do this morning is maybe just, because we've got some new people on the call here, just kind of give you an idea of why they evolved, how they evolved, and what the value of them is. Now, I'm not going to do a deep dive into each specific product and all its intricacies, but I want to just kind of hit it on a high level. So whole life, the whole idea behind whole life was they talked about the guarantees, okay? And I'm going to just abbreviate here because I don't type real fast. So whole life was guaranteed. Now, what was guaranteed in whole life? Now, let me come and frame it for you, okay? The cost of insurance was guaranteed. So we'll just call that COIs, right? Cost of insurance. And then we'll also call it, rate of return. Okay, so rate of return. So cost of insurance. So now I want you to understand this. If, you look at auto insurance is all based on current rates, right? Health insurance is based on current rates. So what would happen if they had to guarantee auto insurance rates? What would that do to the cost of auto insurance? Mike, if you would, just have the dialogue with me here. What do you think that would do to the cost of insurance on your auto insurance if they had to guarantee the rate?
Probably make it higher.
Right. It would have to make it higher, right? Because they're saying that we're going to guarantee your premium from your age 30 until you stop driving, let's say at 85 or whatever, 80. And that means your premium would have to go up, right? So by virtue of the word guarantee, that means higher COIs, higher cost of insurance, because they're guaranteeing that your premium won't change. Now, the second thing is rate of return. To give you an example, who guarantees a rate of return?
Banks.
Banks. And what's the rate of return, say, on a passbook savings account for a guaranteed rate?
0.01.
There you go. Right. Like 0.25%, right?
Right.
So once again, the word guarantee, if we have to guarantee the rate of return is going to be lower as per the example of the bank, right? Guaranteed rate of return, well, we don't know what bond markets are going to do over the lifetime. So we know what we're going to do. We're going to just reduce it and say it's guaranteed. Passbook savings account, 0.25%. So whole life, in the old days, it paid 1 to 2%. So by virtue of the word guarantee, you had a high cost of insurance and a low rate of return. I think you can understand why now the product did not perform very, very well because of virtually the word guarantee. Now, so then what happened was Universal Life was born. And Universal Life initially was born to compete against whole life. And what it did is it based everything off of current rates of return, okay? Now, what's the current rate of return? Now, of course, with current rate of return, what you have is you have the mortality based on current mortality, right? Now, if you look back 40 years ago, if you look back to when Social Security was founded, right, the average person lived till they were age 62. So that's why they started Social Security at age 65. Well, today, the mortality is 87. So therefore, if you had a guaranteed whole life policy with guaranteed rates of return from, say, 30 years ago, and mortality has increased, you're paying way too much for that product. Does that make sense? So on the current rates of return, the COIs will be lower. Now, why would they be lower? Because they're based on current rates, like your auto insurance, right? We said if your auto insurance was guaranteed, the premium would be higher. By virtue of it being current rates, the premium is lower. So in universal life, it's the same thing, right? By virtue of it being current rates, the cost of insurance is lower. Secondly, when we talk about the rate of return, well, based on current rates, the current rates would make it higher, right? So if you were in a money market account, just to give a comparison to, say, a bank savings account, a money market account would be higher because it's more based on current rates versus a guaranteed rate. So how does that apply to universal life and cash value life insurance? Well, whole life, the rates of return were guaranteed, so they were low, 1% to 2%. In a universal life plan, they were current, so the rates were higher, okay? Now, the challenge with this here is the way universal life was sold. It wasn't always sold the best way, right? It was sold with high expectations of returns. In fact, in the early days, you know, guys like Brent Lundgren, who I know are on the call, will remember this, being in the business. Well, they were projecting 12% returns. Well, that obviously, happened for a little while, but then it stopped happening, okay? So from universal life, now they said, well, we'd like to get market-like returns in the same type of product. So how does it evolve? Well, variable universal life was born. So basically you have the same chassis based on current rates, right? It's the same chassis, so nothing has changed. When you look at the COIs are the same based on current. And then you look at rate of return. Well, the rate of return was based on mutual fund sub-accounts, okay? So basically, you had a variable product that had mutual fund sub-accounts. Now, so this was the evolution, right? So remember, we went from whole life, low rates of return, high cost of insurance. We went to a universal life chassis, which meant lower cost of insurance, higher rates of return. Then it graduated to another level where they said, well, we'd like to have stock market-like returns. So they took the same chassis, low cost of insurance, and took the rate of return and used mutual fund sub-accounts. Good and bad, right? Double-edged sword, kind of like the red line. So what happened is when the market went up, yes, those accounts went up, just like the red line. What happened when the accounts went down? Those accounts went down, just like the red line. So in 2008, if you were in a variable universal life policy, when the market and most mutual fund accounts would have dropped, well, growth accounts would have dropped between 35 and 40%, guess what happened to your cash? It dropped 30 or 40%. And it would operate just like a mutual fund. So what happened after that? Well, that's when indexed universal life was born. Same thing, same chassis, universal life, right? Where you had current rates of return. And you had, the COIs were based on current rates. Now, the rate of return was based on an index strategy, right? Which is what we talk about all the time. And what's the value here? No losses. That's the big deal. See, when you look at indexing the way it's done in our index universal life policy, again, same chassis, low cost of insurance based on current rates. And by the way, are people living longer or shorter, Mike?
Longer.
They're living longer, right? So where a lot of the fallacy in universal life is that, wow, what happens when you get older and the rates go, well, it's all based on current rates. So if you're spending a whole lot less now, that means more money is going into your cash accumulation accounts. And we're going to talk about the cash accumulation account in a minute. But the reality of it is, if people are living longer, wouldn't that mean the cost of insurance typically would stay lower in theory, right? If you're living longer, they don't have to raise rates. The cost of mortality is not more because people are living longer. So therefore, those current rates would stay lower, okay? Now, we talk about no losses, and this is a key part, right? See, variable universal life wasn't necessarily a bad product until the losses came. What's the index? Well, of course, you can have an indexing strategies. There's lots of indexing strategies, right? And the whole purpose of those indexing strategies is for people not to lose money. So the market can go up, right? You can have, say, a 12 to 13% cap. Most of you know what that means, right? So based on the S&P, whatever the S&P does, you get, we'll just say 12%, hypothetically, okay? You get 12%. So if the S&P is 20, you get 12. If the S&P is 9, you get 9. If the S&P is negative 10, you get 0. Never lose money. That's a good thing, isn't it? Never to lose money. Well, now you have some that are, now you have uncapped strategies, okay? Some of you know, like with our carriers, with F&G, we have the real estate index, uncapped. And what they have is a spread, okay? The spread, for instance, is, I believe, 1.5% currently. So whatever that return is, if it's 20%, you get 18.5. If it's 10, you get 8.5. And the beauty of that is that it's truly uncapped, right? So it's not just up to 12 or 13%, could go as high as 30% theoretically, and you'd end up with 28.5. You also have, you know, with AIG, uncapped, no spread. Now that's incredible, right? When you look at one of the Merrill Lynch Strategic Balance account within AIG, well, that's uncapped with no spread. So if it earns 12, you get 12. If it's 11, you get 11. If you get 5, I mean, if it's 5, you get 5. If it's negative 10, you get 0. Never a loss. Now that's, folks, that's super, super important when you're talking about average rate of return. Maybe we'll talk about that a little bit too when I wrap this up. You know, what really does average rate of return mean? The other thing you have here with Index Universe, you have an annual reset. What does that mean? Annual reset means the floor is set every year again on your anniversary. So theoretically, Mike, you've got $10,000 in your account, okay? You earned, you know, 10% for the year. Oh, 10% for the year. So what you ended up earning was on that was $1,000, right?
Mm-hmm.
So now your new cap, your new floor is $11,000. That's the new floor set on your anniversary. So what happens? Let's say the market drops 20% in your second year. You remain at 11,000. You don't lose anything. Let's say in the third year, it goes up, whatever, 5%, just hypothetically. Well, 5%, that's what, $550, right?
Yeah.
If that's right. So you're at 11,550, and that is your new floor, okay? So if the market tanks the next year, it never goes below 11,550. Thus, the blue line we talked to everybody about, the value of red line, blue line, and how important it is to have a strategy where you could never lose money. Now, and like I said, I can go pretty deep into this here, but I just want you to see the evolution. So sometimes, how does this relate to our business? Sometimes you're talking to somebody that says, well, that's like a whole life policy. No, it's not. It's not even close to a whole life policy, okay? I mean, it's as close as a Ferrari and a Volkswagen Beetle. That's how close it is, okay? So there's no comparison. Well, this is like universal life. Well, it's universal life is the chassis, but it works a whole lot different. Or this is like variable universal life. Well, that's the closest one to it, except no market losses. Now, why is that important? We look at average rate of return, right? So let's talk about average rate of return. It's rate of return divided by the number of years. So let's just say it's 20 years, okay? So you take that on, you divide it, but that doesn't really give us a true picture of average rate of return and what your account does. For instance, what if you made 100% one year, okay? And then you lost 50% the next year, and then you made 100% the next year, and then you lost 50%. Now, I know that's a kind of a crazy example, but let's take an average, right? 2 years that were up were 200%. The 2 years that were down were 50 and 50, that's 100, right? So if we use the math here, we've got total return, which was 100. Everybody, Mike, you with me here? Is this clear? Divided by 4 years equals what? 25%. So you made 25% of your money.
No.
So you get your statement and it says average rate of return 25%. Okay, now let's put the math to it. So let's say you got $10,000. It goes up 100%. So what do you have? 20,000, right?
Yes.
Okay. Now what happens the next year? What do we say? The next year, it goes down 50%. So what do you have? 10,000.
1,000. Yep.
Now the next year, it goes up, right? So you got 10,000. It goes up 100%. You're back to 20,000, right?
Yeah.
The next year, your 20,000 goes down 50%, and you're back to 10,000. So in your 4 years, you started here, you ended here. Isn't that the same money?
Yes.
So you made no money, right?
No, not a
But
cent.
your statement came in and said your average rate of return was 25%. But that's not what your actual return was. Your average was 25, but your actual was 0. Now you understand why so many people are upset when they get their 401k statement. Say, I don't get it. You know, it says I made 8.92% for the last 4 years, but when I do the math on my account, it's only 2%. That's because, see, when you're talking about average rate of return and actual rate of return, there's two different things. Now, why is it different when we say average rate of return? Because we have no losses. See, there are no losses in our account, and your account steps up every year. So what does that mean? So basically what happens is this here. If you make 5% 1 year, right? 0%. And then the next year you make 12%. And then the next year you make 10%. So we're going to add 3% the last year, okay? So now that 5-year period of time, you earned 5, 17, 27. You earned a total of 30%. Is that right, Mike? My math right? 30%.
Yes.
Now, if you divide that by the number of years, okay, by 5, what did you earn? You earned 6%. So we started with 10,000,
Yep.
right? And what was it after year 1? Right, we earned 5%, so it's 10,500, right?
Yes.
Then after year 2, times 12% was what?
Times 12% is 11,760.
Okay. Then the next year we made 10%.
Which is 12,936.
And then next year we made 3%.
Which is 13,324.
Okay. So you can see the difference, right? Because we lost no money, right? You made 5% the first year, nothing the next year. Then you made 12%, so it's 11,760, 10% the next year, 3%. You've got 13,324. Well, if you take the percentage gain, right? 3,324, and you divide that by 10,000, 0.33.
Yep.
So in actuality, how much did you earn? Now we said an average was 6%, right? You earn 0.33. And of course, there's, you know, because of the dollars in here, but if you take so your account went up 33%. in 5 years. You get that? If you divide 0.33 by 5 years, you're going to come up with 0.6 whatever, 0.25 or whatever it is, okay? But my point is, you can see that it's a true rate of return when we say our average rate of return. So when we show in our proposals 7.11%, for instance, with Anaco, and we show the 20-year history where it says this has done 7.3 for 20 years, whereas the S&P did 5.09. Our number is an actual number, just as we showed you here. When you look at the typical average rate of return, it's not that way, because as soon as you have a loss, you have this scenario happening, right? You have this scenario happening with the 10 goes to 20, 20 goes back to 10. It's the same thing. Now, I made this real simple for everybody, but the reality of it is you can see the difference between actual rate of return and average rate of return. And that's a key point, because when you're out there talking to people and we're telling them that the average rate of return, if they're thinking like we just talked about, well, my average rate of return says 8, but I got 2, so what makes yours different? What makes ours different is there are no losses. So therefore, a true rate of return is a true rate of return. So if I look at the first 2 years here, 5% 0, and I divide that by 2, that's 2.5%. Well, my account did go up 5% in 2 years, right? It started at 10. By the end of year 2, it was, year 1, it was 10.5. At the end of year 3, where I got 0, it was still 10.5. Well, what's my rate of return average per year? 2.5%. Well, that's exactly right, because 5 plus 0 was 5, divided by 2 is 2.5. You see, with no losses. Now, if you put a loss in there, it changes everything. When your account can go backwards, it needs a lot more return to go forward, right? So in other words, going back to this example, when this account, when your 10 went to 20, okay, when you lose just 50%, you made 100% to get to 20. You only lost 50, but it went back to 10. Now to go back to 20, you'd say, well, if I just get 50 back, I'm even. No. 50 back only brings you to 15. You got to go at 100 to come back to ground zero, okay? So that's what happens when you have losses in your account. So anyway, that hopefully will give you an example. Like I said, I wanted to kind of give you an idea of the evolution of the business and how it works and why it's so important for you to have an understanding of what we do, so you can take it to the next level, okay? So, Mike, I don't know, do you have any questions with that? Does any of that
we can open up. You can either chat or in the Q&A section, you can do so and let us know if you have questions, and I'd be more than happy to pass those questions on. But I think what you just did here is fantastic. I do have something that I want to ask you, though. In that scenario where, like you just described, you need 100 to get back to where you were, but when you lose 50, that type situation, right, that's actually beneficial for us in the index UL, isn't it?
Sure it is. Sure it is, because you don't lose that, okay? In other words, if we go here, I found the clear button, folks, okay? So if you made 100%, okay, 1 year, and the next year the market dropped 50%, hypothetically, right? What do you get? 0.
Right.
Okay. So if your account was at 10,000, now of course you'd have to be in an, I mean, we're using a dramatic number here, but just for the point of example, gang, your 100,000 went, your 10,000 went to 20,000. The next year, when you got 0%, it stays at 20,000. Okay. The next year it goes up 100% again, per our example, right? The 100%. In other words, if we had, let's go back here. I'm sorry. Let me make it clear and put it in the same picture. Okay. 100% minus 50%. That's what we said, right?
Mm-hmm.
Plus 100% minus 50%. And we said the average rate of return was 25%. And we know that that's not true in terms of actual rate of return. So this was the average rate of return, but the actual rate of return was what?
0.
0. Okay. So now let's show it in our plan. Well, first year you got 10,000. Well, you started with 10,000. It went to 20,000. The next year it lost 50%. So it stayed at 20,000, right?
Yes.
Because ours is no losses. The next year it went up again 100%. So now that's 40,000, isn't it?
Yep.
And the next year it lost 50%, which means we stayed the same.
Right.
So we started with 10,000, right? Now it's 40,000. Oh, so what was our rate of return?
25%.
10 to 40. So if you said, okay, well, we made 300,000, excuse me, I always want to think big, folks, okay? So if you take 10,000 and you made 30,000, what did you make on your money? Okay, so you take the difference, which is 330,000, divide it by the number 10,000, and what did we make? So here we made 0. Here we made 300%. If you really think about it, okay? Well, in actuality, the way it would work is you made 200%, right? Because you had no losses here. So your average rate of return per year was 50%, right? 100 plus 0 plus 100 plus 0 divided by 4, 200 divided by 4 is 50%. You made 50% per year on your money. So that's the average rate of return. But the actual rate of return was 300%, wasn't it? And that's because there's no losses.
Awesome.
Because your account went from 10,000 to 40,000. So you got to understand, that's the magic of index UL. Now, take into consideration, you have access to your money tax-free. Take into consideration that you can literally pull $20,000 of this 40,000, and the 40,000 is still making you money. It never leaves your account. But you took the 20,000 out and you did something else with it. Well, that 40,000 is still in your account earning interest and accumulating value. Now, of course, you have a loan on that. How do they get that back? You die, they subtract it. You surrender, they subtract it. But the fact is, the 40,000 keeps making you money. So you never lose the opportunity cost in your money. That's a whole nother webinar we can do just on that. For today's purposes, I just wanted to show you the evolution and how we say the industry has changed. They have. You know, I can tell you 32 years ago, the only product we would see a lot of was whole life. And of course, buy term and invest the difference made a whole lot of sense, okay? Then we started to see universal life. Then we started to see variable universal life. Then index universal life was born about 20 years ago. And now, of course, we know the big deal now is living benefits, right? So now on top of the index universal life, which gives you all the growth, gives you all the access to money, gives you the death benefit, gives you possible tax-free retirement, and a whole bunch of features along the way, we're saying, look, not only if you live or die do we have you covered, now if you get sick, by virtue of living benefits, we got you covered, right? So, I mean, you can see why this is such a big crusade. I can't imagine what the next one's going to be, but living benefits is a huge one. So today was to give you an idea of the evolution and how it all works. So when you're out there talking to people and they may say, well, I got something like that. You know, I've got this universal life I bought 20 years ago. Not the same thing. Okay. Well, I got this variable universal life. Not the same thing. Okay. Or if you're talking to an agent, you know, sometimes if you're talking to, say, for instance, a Primerica agent, I'll give you an example. They think everything that has cash value is whole life. It is not. Clearly, it is not. And that's just a lack of education or ignorance on their part where they don't know the difference. So be patient, be understanding, but realize that they don't have an idea of what they're talking about because they've never been educated on how the products work, okay? Now, I'll say this in closing for this section here, or on this point, and if we have questions, we'll keep it open. But here's what you have to understand. A properly structured index universal life will surpass, in my opinion, any other type of savings vehicle you can have. The key words there are properly structured, okay? If you're max funding an IUL, meaning minimum face amount per the amount of money you're putting in, and you're maxing it out, that's where you get the greatest value. Now, if you don't max it, but you're halfway, are you going to have the cash you thought you'd have? Of course not, because you're putting less money in. Do all the benefits apply? Absolutely. Nothing changes because you're putting less in it. But the more you put in it, the more benefit you get out of that product. The more income it's going to throw you down the road, the more access you have to cash along the way, and it will never run out because you're putting typically somewhere between 8 and 10 times the cost of insurance in. So if your cost of insurance is this high and you're putting this much in, what's the probability of you not having enough money in there for it to cover? It's not possible, okay? Because you're putting a lot more in that's required, so it's building a huge pile of cash, okay? So anyway, Mike, I don't know if any questions came up. If you have any, otherwise we can wrap it up here. We're